and welcome everybody to the Oil and Gas Retirement Workshop. I am Kerry Facer, and with me, Len Hanson, and we will be hosting today's retirement planning webinar. Thank you for joining us. Len, just to double check, you're there, everything good?
I'm here. Can you hear me?
Buddy? I can hear you just fine.
Okay, cool.
So if anybody wants any of our disclosures or copy of our ADV, you can reach out and we provide you a copy of our ADV. So today, let's get into it. We have 6 steps to share with you for a successful retirement. These are steps we've put together over the years and tried to simplify it. We are going to be spending about 30 minutes together today. And anybody who wants to share this, there'll be a replay available in a few days after we wrap this up. Attend the workshop. Number 1, that's done. You're here. Great job. We're going to go through our retirement handbook. This is something that Len helped Warren Street put together for you. Len worked at Chevron for the El Segundo refinery for about 24 years, but 30 plus with Chevron total, and has helped put together this handbook and toolkit. So we'll break that down for you here in a moment. And then we're going to talk about the vision for retirement, life beyond work, next steps as far as what we do as advisors, our pricing and all that good stuff, and then finally retire and enjoy all life has to offer. So our team. So we have an ensemble team. That is Len Hanson, 4th from the right, who's on the call with us. That is me, 5th from the left, and the rest of our team. We are a true ensemble. What that means is you have the entire team behind you when you do decide to work with us, and that's important to know. IRS Rule of 55. Why are we starting with this? Because a lot of the themes, when Len and I have hosted a lot of retirement planning workshops together over the years, specifically for the oil and gas industry and the El Segundo refinery for Chevron. And the rule of 55 is really important because a lot of our clients want to retire early, and understanding the rule of 55 and how to retire from Chevron without any penalties and how to make the most of your 401k is really where we spend a lot of our time talking to anybody attending a retirement workshop like this. And so we're going to break that down for you a little bit in the handbook. And go into the details there, but just real important to know about the IRS Rule of 55, and that'll be a little theme as we go through today's workshop. So read the retirement handbook. One thing to note is this is all available for you on our website. If you go to warrenstreet.com, that's WARREN, warrenstreet.com, and then go to the Who We Serve section, and under there, there'll be a oil and gas. We have all the resources available to you. So the handbook and the toolkit are there, as well as some past videos that Len has put together in regards to everything from Chevron stock, ESOP shares, how to retire without penalties, the 55 rule, etc. So here we are, the handbook. So let's go into this. First, have a plan. Number 2, seriously have a plan. We want to see our clients retire with a plan, and not just enter into retirement without one. This is a big decision, and you want to make sure you get it done appropriately. Retire once without having to come back to work if that is not in your plan. But as far as the timing, there's a lot of different dates to retire, and things change constantly. So we don't want to step in it here as far as when and how to get the most out of your vacation and sick time. But what's important is to talk with somebody like Warren Street and Len as far as what your options are. And usually what we'll recommend is to call in and find out exactly what you're eligible for your bonuses, vacation, and sick time, because it is specific per person when you hired on, and if there was any gaps in service, et cetera. So that's a very custom thing, but you do want to weigh your options there as far as what you have available to you for vacation, sick time, and bonuses. And that's something Len is really good at helping our clients walk through. Len, anything specific there in regards to that?
No, just that there could be a change to the bonus, the way the bonus works, and I'm just gathering information on that. So things have changed a little bit. Vacation hasn't changed. Sick time, that stuff hasn't changed, but bonuses have.
So stay tuned. Hopefully by the March or April, I think we have one scheduled for April, a retirement webinar. We'll have some clarity for everybody on what's going to take place there with the change. So stay tuned. Number 4, you want to retire early. We all hear that 55 is the desired retirement age, kind of the first milestone that everybody wants. I mean, 50 is popular. 50 is very difficult to do. Just the math is, it's a long stretch. Len's nodding his head if you can't see that, but he agrees. Len, you hear 55 probably is the most common date.
Well, definitely 55 is the earliest I think you should think about retiring, because it just allows so many different things that maybe retiring a little bit earlier than 55 would allow. There's hoops you have to jump through if you retire before 55, but at 55 you can actually live off of your retirement money in the 401k, and you're allowed to take distributions without penalties. Typically you hear, most people think it's 59 and a half or 60, something like that. But the big number, the important number is 55. You can live off of your retirement money in your 401k without penalties. That's key, without penalties. And then at 59 and a half, you can have your money in your 401k, an IRA, doesn't matter. You won't pay penalties at 59 and a half. But the 55 rule is something I did myself. I retired at 55. So I had access to my 401k if I needed it. And I did take some distributions from that and not pay penalties on it. It was great. I'm 59 and a half now. So I can, everything's open to me now at this point.
Yeah, so when you're looking at your options, just know that the 55 number is important, and to get you to 59 and a half, you have a lot of flexibility, specifically with the Chevron 401k plan, and that is company specific. You may be listening to this and not working for Chevron. Every company plan and plan document is different, and so you need to know what your options are. But for most of our clients who are listening to this, a lot are coming from the El Segundo refining rule where Len used to work, and so that is specific to Chevron. And to know that you can leave the money there and take it direct from the 401k plan is a Chevron specific item. So if you're not at Chevron, let us know where you work, and then we can try to help you find out what your options are. Number 5 here, budget for medical expenses. So that's something that's currently coming out of your paycheck, but when you retire, you're going to have a new item on your budget that you're probably not accounting for today. So when you're going through and you're planning, your retirement and saying, okay, I think I need about $6,000 or $7,000 a month as an example. Retirement medical expense is currently being taken out of the paycheck. That's one that's going to be paid for, out of pocket by you, your portion. So just have a line on your budget that accounts for that. What that number is again, it's another question you're going to want to talk to benefits about, and we can help facilitate that call. But the big item to take away from today's workshop is to add that item back in. So if your current budget today is $5,000, and your cost for medical might be $800 or $900 a month, you're going to want to put that in for your retirement planning budget template. 6, saying goodbye to credit card debt. This is an easy one for us to give advice on. It's black and white. If you use your credit card to earn points or rewards, no problem, pay it off every month. But if you have a revolving balance, one that you haven't been able to pay off for even a couple of months, maybe it was from the holidays, get that balance gone. It is really something. A revolving balance on a credit card is costing you a lot of money. The lowest interest rates are going to be around 10%, and the high side probably 24%. And so there isn't anything out there that will earn, without risk better than that. So if you have credit card debt, please just pay it off. If you don't have the cash to do so, that even comes back to why it's going to be so important to have a budget, which we're going to cover here in the toolkit section. But yeah, please get that paid off. If you got the cash available today and you're listening to this, you have my permission to go ahead and write a check or do a transfer and get the credit card balance down to 0. And then that leads to the next part, is building up 6 months of emergency reserves. In this example here, it says $4,000 a month, so $24,000 in savings and checking, not invested, not in cryptocurrencies, not in NFTs, not in stock, not in bonds, but cash. Sure, if you want to transfer some of that, if you have like a bill payer account with maybe $5,000 or $10,000 in there, that's the money that maybe pays the mortgage or the credit card bill each month, is fine. Keep that cash on hand for that bill payer account. But if you have above that and you want to put it into a higher savings, higher interest savings account with your bank, or maybe it's the Chevron Credit Union, fine. They're not paying a whole lot, but 0.1 or 0.2, or on the high side, maybe with an online savings account, 0.5% is better than nothing. But this is money that we don't want to see you investing. We want to have a cash cushion. And yes, if you have more than 6 months, that is fine. At some point, we will probably give you advice or render counsel that says maybe put some of that money to work. It could even be in a CD or a conservative bond portfolio. But that's kind of a per family decision that we can help you with. But 6 months emergency reserves at a bare minimum. Anything higher than that's a fantastic problem to have. The handbook. So now we're on number 8, right? Is saying about we mentioned earlier. It's the budget. So it's no fun to build a budget, but you'd rather walk into retirement knowing what the number actually is than honestly just kind of lying to ourselves about it, because every time we do a budget, we add everything up and we always scratch our heads and think this can't be correct. How is it so much? But the important thing of the budget is to be able to look at it all, find 1 or 2 things, maybe 3 or 4 that bother you, and then go back to the budget to work on reducing that amount or eliminating it entirely. Number 9, Social Security options. Hey, just because you can take it at 62 doesn't mean you have to. It's a reduction of benefits by 25 or 30%, depending on your full retirement age, whether that's 66 or 66 in some months, all the way to 67. But if you're healthy today and your life expectancy is, it's very probable you could live into your late 80s, early 90s, and being healthy today. And I'm assuming you're somewhere between 50 and probably 65 years old if you're attending a retirement planning workshop. So we'd at least share that it's probably advantageous to allow yourself some time to think about this decision, to weigh your options, and take a look at taking it later, just to pick up a little bit more money per month for your retirement plan. Very, very helpful. Len, any thoughts on this? I know you do a lot of this with clients, and they're always probably saying, I don't know, not always, but they're probably worried that Social Security might go away. I mean, what are you hearing out there from the clients?
Most people usually say they're going to take it at 62. They're concerned that it's not going to be around, later on. And so usually if somebody retires at 55, it's not a discussion we have to have right away.
Mm-hmm.
And just say, put that on the back burner. That's something we can talk about at 62 or through the years, and try to get ready for the right decision for that person, especially if they've retired in their late 50s. And let's say they've been retired for 5 years. The decision to take Social Security is different with everyone, depending on how their retirement's going,
Mm-hmm.
how their portfolio is going. So, but
Yeah.
Usually I hear 62, and then we have to, we work from there. And
Yeah.
not very many do take it at 62. Just so you know that we usually decide or help them decide to wait a little longer.
Right. And then one thing too, you've probably heard this a lot, Len, and I know we have, but is bridging the gap. So a lot of people think, well, how am I going to retire? If I retire at 62 and I don't take Social Security until 66, how am I going to, make ends meet? And what we'll actually show in the planning software is a client spending a little bit more from the 401k or a little bit more from the cash balance from 62 to say 66. Excuse me. And then once that larger amount's turned on at 66, turn the withdrawals way down, right? So basically supplement retirement income with Social Security. And we have the data on the back end of the planning software to show that it actually works, and a lot of our clients don't like spending more from their 401k, but if they can see it actually produces more income net to them through the course of retirement, I think they can at least entertain that idea. And so that's one easy way to fix that time gap.
Mm-hmm.
Invest for retirement, max out your 401k. We say that delicately, but we traditionally mean it. Is max out your 401k is if you're nearing retirement, you're probably in your highest earning income years, and you're probably losing a lot of deductions, meaning the mortgage interest is going away. Assuming you could take a standard deduction or take something above that with your other stacked itemized deductions. But we've seen as clients are near retirement, they're traditionally just losing deductions. I mean, kids are no longer dependents. They're moved out of the house, or they're off to college, or they're in the workforce now. And the mortgage is pretty much all gone away. So the mortgage interest is disappearing. And so one of the simplest things you can do to pick up a large deduction every year is to max out your 401k and to take advantage of the catch-up provision. So if you're 50 years or older, calculate your standard deferral plus the catch-up and put in, $27,000 a year pre-tax. Really, really easy way to pick up a large deduction and add a bunch to your 401k right before you're getting ready to retire. So it's kind of twofold there. And then as far as the ESOP shares, I don't want to get into this too much because we don't have enough time, but if you have questions about your ESOP shares, that's where I'm going to plug Len here. Is at the end, we're going to give you some contact information to follow up, but get in touch with Len as far as what to do with your ESOP shares and your common stock shares. And I'll just leave that at that for now.
But say one thing on that,
Yeah,
Carrie, is if you're, if you still have ESOP shares, if you do have ESOP shares and you're thinking about selling shares, don't sell the ESOP shares.
Yeah.
Chevron's at a 10-year high right now. So people are looking at selling some Chevron to take a little off of that. Make sure it's not the ESOP shares. You're going to sell the common shares and not the ESOP, and I can help with that if anybody needs help with it.
Very good. Thank you, Len. I was going to let everybody get at the end, then you're going to drop that so people can stay longer to the webinar. This content can be a little slow sometimes, but yeah, no, that's the reality there is keep the ESOPs. Why, I guess, is why you'd want to talk to Len about that, but it's basically comes down to taxes. Again, like we said at the beginning, 1 and 2 was have a plan, and we're going to remind you one more time, put a plan together. Social Security strategies, 62 to 67 is your age to claim. You can wait until age 70. You get an 8% increase in benefit every year you wait, and it is linear. So from 66 to 67 is your full retirement age. That's when you receive your statement, whether it's online or mailed, but you'll see your full retirement age, or FRA as they call it. And it's somewhere between 66 and 67, but you can, if you're healthy and you have enough income and you're not worried about it, and you think you could live to be in your 90s, you could wait until age 70 and receive a much larger benefit. So again, every year you wait, you get another 8% increase in your retirement income benefit from the Social Security Administration. So that's a nice little increase. Most, I'll be honest, most don't wait till 70. They like the idea of it, but they have waited from 62 to 66 or 62 to 67, and they've been patient enough to get that increased benefit. And they traditionally like to take it at 66 or 67. But we have had a few clients wait to take it till age 70. Len, any thoughts on that, what you see out there?
Well, my thought on it, I'm going to wait till 70. The reason for that is I have a wife is younger. My wife is younger than I am. And so basically it'll help her spousal benefits. So, and I don't think I'm going to need it right now. I mean, I'm still a ways away, but I don't think I'm going to need it. And it just makes sense to me to wait a little longer, wait to 70. So she gets a bigger benefit in the future. So that's just, everybody's going to be a little bit different that way. And
yeah, that's a good,
that.
no, that is a good point. It's here on the right is the spousal benefits, things to consider is the age of your spouse, and longevity is really a key determiner. So before you just take it at 62, weigh your options. If you're trying to figure this out on your own, just, our point is to, spend some time thinking about your different options, run some calculations. If you work with us, this is something we will do for you. We'll present you options. That way you can at least make an informed decision. Whether or not you take it at 62 or 70, that's going to be something we can, help you decide, but it's really going to be your decision based on your personal situation and your expected life expectancy. And that's something that's obviously very difficult to, calculate, but at least you'll have some numbers behind it to make an informed decision. And that's a very good point, Len, is you do need to be thinking about your spouse in this calculation. Let's do the toolkit. So the toolkit's real simple. It's a net worth scorecard and a budget. And again, this is on our website, warrenstreet.com, and then go to who we serve, and there'll be an oil and gas section. And then you can download this from the site. We get asked all the time, how to get started planning for retirement. And I think a lot of people are I don't know, this is just my personal opinion, are not that excited to know that the two things we ask you to start with is a net worth scorecard and a budget template, because it sounds like the most boring thing you'd have to possibly do to get ready for retirement, which is a very exciting time. But the reality is it's a great starting point, because if you're to talk to any advisor on our team, or you talk to Len and you're like, I think I want to retire, and you came to a first appointment with a net worth scorecard filled out and a budget template filled out, and I'm not saying it has to be perfect, but if you spent 15 or 20 minutes on each one, Lynn, would you say they're way ahead of the curve, kind of on track with everybody else? Or, I mean, where would they be way ahead of the curve as far as what people, bring to a first appointment to retire? Is that right?
Absolutely. And yeah, usually, yeah, people aren't, they're not up to date with their assets and liabilities. And we kind of go through that sometimes, through that exercise when we do an establish with someone.
Yeah.
So it's not, yeah, I'd say 5% of the people maybe have an idea.
Yeah.
And so they're coming to us asking if they can retire, and we're going to need this information to help you understand if you are in position to retire or when you will be.
I think 5% is a fair number. I mean, Lynn, between the two of us, we've probably had a collective 400 or 500, meetings like that. And it's a lot of people have this, they'll bring the stack, but to actually take that information and put it all in a single sheet in one place, it's very helpful for you too. If you're filling this out, is to see everything in one place. And it's, this is when you talk about like any business's balance sheet, it's assets and liabilities. It's as simple as that. So this is obviously a personal balance sheet, but this will give you a clear idea of what you have on the liability side as well, to go, hopefully it's just a mortgage and maybe one car loan, but hopefully there's not more than, 3 or 4 items on the liabilities. In an ideal world, there's no debt. We understand a lot of our clients carry mortgages in retirement. And while we're on that topic, that's fine. Don't feel like you have to have the house paid off to retire. We have lots of clients retire with 7, 8, 9, 10, maybe even 15 years left on a mortgage. And that's, it's doable. But the point here is to take 15, 20 minutes and just get everything listed out as a starting point to see what you have. Because then here, I would advise the same thing, is not to make a perfect budget, is to spend about 15 or 20 minutes completing this. Because if you try to go in, you start logging into accounts, and then you need a password reset, and then you in the email notification to reset it starts becoming this big project. So instead, most of our clients, and Lynn, I think you agree here, is know 95% of the stuff off the top of their head.
Yeah, absolutely.
Yeah. And so, you know what your rent is, what the mortgage is, about what you spend every month in groceries. It's probably not perfect, but if it's 200 to 300 or if it's 500 to 600, and dining out, maybe the grocery bill's way less because you do a lot of dining out. So you could at least get those two close, as opposed to making them perfect. And then the other things are pretty easy. Everybody knows what their Edison, bill or their electric bill might be in the area, and all right, it's 150 on average a month. So go through, fill it out. But the important thing is, as you do this, is you'll come back, and if you want to reduce the number, is to then be able to see everything in one place to say, maybe it's the cable and internet. Maybe the bill's just high and it needs to be, dropped down because it's bothering you. Or if you have I've seen people with 2 gym memberships, and they have one at, an LA Fitness because it's $5 a month, and one at Planet Fitness because it's closer to their house. And this just might be that final moment where you finally go, fine, I'm getting rid of one of those. And, saving a few dollars a month might not feel like it's worth a lot for the time it takes to get that to go away. But if you look at that expense to your personal, retirement plan over the next 35 or 40 years, it really does add up. So again, about 15, 20 minutes on each one of those. And before we jump into vision, anything left on the budget? I always feel like I spend too long on the budget, so
I think you could.
I did.
Yeah, no, I think you covered it. I mean, it's torture, a little bit of torture, but it's worth it to get it started at least and get somewhere. Some people spend too much time on, like you said, they really they go through all their bills for the entire year. It doesn't need to be like that.
Yeah.
To start with, just get get something started, and you can revise it as you go and make sure it's right before retirement, right? And you've got those numbers correct then.
Yeah, exactly. Yeah. Progress over perfection there.
Yep.
Let's talk about your vision. This is something that Len is shared a lot about with his personal vision for retirement. Is Len started in the investment community back in 1991 as a stockbroker, helping just more hobby than anything. It was full time for Chevron, but enjoyed the markets, liked buying stocks, liked staying up to speed of what was going on in the investment community. But Len's real vision was to be full-time advisor to his clients. And a lot of his friends were working at Chevron and asking him for 401k help. And so, of course, this was after hours, not during Chevron time. It was on the weekends. Len was giving them counsel and saying, "This is what I would do if I were you. I would diversify. I would, you're young, fine, have some aggressive stocks in there, but just know they're going to be volatile. So when they go down, don't panic. And if you had a huge concentration in Chevron stock, keep the ESOP shares, as I mentioned earlier, but probably buy some other things in there just in case Chevron has an issue like ExxonMobil's had in the past with the spill or anything like that, or BP, or any issues that you all know about that could hurt the stock in a quick amount of time." And so, but my point with the vision here is, Len and I have seen when we talk to clients about, okay, finally, think about you're going to retire now. You're going to have all this time where you're not getting up early to get to work, to commute, to put a 8, 10, 12-hour day in, then come home. What are you going to do with your new time? And we'd like to talk about that now so you can start getting excited about traveling again or getting back into hobbies or passions that you haven't made time for just because you've been busy working and providing. So we just want to remind you now is to start getting creative around that idea, to start thinking about what you want to do with this new time. And then where you're going to live. Len, I feel like I hear this a lot. You would know better than I would, kind of on the daily with Chevron. But are a lot of people talking about leaving, the LA area or the South Bay area and moving out of state?
For retirees, I'd say it's Chevron retires that I specialize in. I'd say half, 50% are leaving the state.
Yeah.
Places like Tennessee and even Oklahoma, a lot of Texas. Obviously, we have a lot of retirees in Texas already, but now they're going to places like Oklahoma and Tennessee. I got a couple of them going to Arizona and Nevada. Obviously, they're trying to stay close because they probably still have family in the area. But yeah, I'd say it's close to 50% moving out of California.
Yeah, I feel it's the same. I mean, if anybody wants to know, we had this in a past workshop. Is can we work with you if you move to a different state? Yes, we can. Obviously, we can work in all 50 states. There's no issues there. But and then now with the last 2 years of the pandemic, our clients have gotten real comfortable with using Zoom for meetings once you've retired and moved. But two things that I want to stress here: weather and relationships. So when you do decide to move out of state, travel there during the nice times. Spend some of your vacation up before you retire to go travel to the place you want to retire. And then I would go back during the winter times. I would go back during times like now where it's a little bit different than the spring or summer months, just to make sure that it's something you can be comfortable with. And then the second part is the relationships, is like Len already mentioned, is where the family is. So where your family and friends are is typically what we see or where we see our clients going. And some are going in groups. We've had clients move to Texas and families going with them. And that's becoming more and more common, to where you see, if it is a 50% number, and Len, I think it's a big number. I don't know if it's 50 or 30 or if it's 60, but it's a big percentage of our clients are leaving the area. The final thing that's important beyond those two is the cost of living. If you're in the LA area, if you're near the refinery, or if you're in South Bay, Orange County, San Diego County, and if you leave Southern California, the odds of you having a reduced cost of living adjustment are very high. So lower standard of living between selling a home here and buying a home out of state, even if the local taxes are higher, your home equity here traditionally will provide a reduced burden by moving out of state. And so you could pay cash for a house or end up with extra cash available. So we see a lot of our clients doing that. And if you're on the kind of fence as far as, or let's say a financial plan is saying you're not quite there, you don't quite have enough money to retire, you're real close, moving out of state, we're not advising you to do this to make the plan work. But if that's something you want to do anyways, we'll add a lot of confidence to a retirement plan, and that is something that we can actually illustrate in real dollars in the software. And but whether relationships is probably most important. Then after that is the added benefits are usually no state income tax on Texas, Nevada, Washington State if you're looking nearby, but it's most likely going to be lower state income tax than California will be.
Mhm.
Yep. Next steps, let's talk about it. So our planning, the way we work is most of our clients come over with retirement income. And so we can manage the investments without having to charge for a plan. We put the plan here is that if you had no investments and you wanted to work with us, just know we would provide a custom quote to you to share with you how you could work with Warren Street without any investments. But the majority of our clients come over with investments from their 401k, their cash balance, and other accounts. And so the schedule to the right is what most of our clients fall under. And most of our clients are also referred to us, and they fall under a friends and family pricing program, which is bundled pricing for group discounts up to 5 families. So if you have more questions about that, let us know. We can send you information on that. But that is something worth noting. And just to give some easy math to this, if 5 families were referred at $1 million each and they were a friends and family group, that would bring an effective price down to about 0.83%. And Len, we have a lot of people that are coming over on the friends and family program. I know, with the amount of referrals you get in the area, that we see people getting to 3, 4, 5 people relatively quick. I mean, quick, like within a couple of years, right? But client and then their friend comes on, and then so you'll see people getting far below the 1% base for the first $1 million. And we like that because we're a team of 11 people, and it keeps us really competitive with Fidelity or Vanguard or anybody else that's doing volume planning. Yet we're a small boutique shop, and we do a lot of very specific and customized planning for our clients, but we are allowed to be competitive on the pricing through that program. And so if you're a client listening to this and you refer to us, you've referred clients, we say thank you. Our planning. So if you did want to get started, we offer a complimentary consultation, no risk. And that's the number one there. It's an established call. That's your hour with Len to get to know how we work, ask questions specific to you with no strings attached. If you decide to not move forward, there's no problem. It's a very small community. The last thing we want is a bad reputation. So we'll do everything we can in that hour with you to put you on track. And to give you some real feedback during that call. However, if you did decide that you wanted to continue working with us and have a next call, we would just do a follow-up, which is the Discover meeting. And then in that time, we would then be able to send you, a customized plan of attack, meaning this is what we think, we do with the investments, and this is what we charge for it, to allow you plenty of time to make a decision before getting started. And it's a big decision. We want our clients to feel very confident when they do make this decision to retire and to partner with a firm like Warren Street. And then, of course, we have lots of data. We understand most of our clients are engineers, and so they need to see the data. And so on the back end of our plans, this is just a snapshot, but we can show you. We can get a pretty good idea from our logic and judgment on how you're tracking and how you're doing. But please know we do use data on the back end to make and support our decisions. And then finally, the investment side. So we have 7 core principles we use to build 3 portfolios in-house that we do manage internally here at Warren Street, which is a stock portfolio, a bond portfolio, and a real asset portfolio. We then take those 3 and blend them to build a custom portfolio for our client that we can then dial in from the far left, from low risk all the way up to high risk, and adjust as needed. So if a client wants to make changes, it's very easy for us to adjust these portfolios specific to them, their retirement plan, their goals, objectives, and risk tolerance. So why are we talking about Chevron stock right here at the end when we're getting close to wrapping this up? Is because this is something we get asked about all the time. And what we want to show here is just a quick little 5-year snapshot of Chevron stock, and this is as of Friday last week. But Chevron stock is the bottom line there, the dark blue, and you can see over the last 5 years, it's done 50.4% cumulative total return, compared to what's on the very top there is the S&P 500 at 113%, so over double the return. Now, why is that important to know? It's because a lot of our years helping people plan for retirement from Chevron, we've seen a lot of them owning too much Chevron stock. And we talk diversification. If you are going to own all Chevron stock, just own the ESOP shares, as Len mentioned earlier. And that's a tax play with that unrealized appreciation. But the reality is, if you're going to take as much risk as owning Chevron stock is, you might as well get rid of the single security risk that comes with owning one company and pick up the S&P 500 where you'd own 500. You would have also done much better in the market over the last 5 years. Now, it's easy for us to go back and say that because we have the data and we didn't know that 5 years ago. Now, in reality, what would be a fair statement is to say, well, we probably wouldn't own just US stocks. If you were working with us, we would probably recommend a little international and a little emerging markets. And so what we put there in the gray was the MSCI ACWI, or the All Country World Index, which shows US stocks, international, and emerging as an index for a blend. So a more balanced approach geographically as well. And it's hard to argue with that. And then we even did it for a 10-year just to show, while Chevron stock has had a really nice run up, this last, I don't know, quarter, it's taken a look at the Chevron stock and knowing that if we want to diversify down, we could at least take a look at it and say, well, here's some other options that might get rid of the single security risk and add some diversification to your portfolio without losing performance. Now, this there's no bonds in any of these examples, and the even more fair statement is that if we're getting ready for retirement, we'd probably be adding some of the boring stuff that hopefully will be stable while the other stuff is unstable during uncertain times. And as you can see here, those three big large corrections down right at 2020 was the global pandemic, and so the recovery has been good, but during that time it's a little scary. So we probably would actually be recommending, and now this is just general recommendation, is a more balanced portfolio. If you're working with us, obviously we would add a lot more in there than just saying bonds, but the point is to have a balanced portfolio to kind of smooth out that ride as you're nearing retirement and when you're in retirement. So 6, retire and enjoy all life has to offer. And so we'll open it up for questions here if there's any questions. Otherwise, we are going to wrap this up. And if you did want to reach out, you can go to our website, warrenstreetwealth.com or warrenstreet.com. They both go to the same place, /schedule. You can also call. We do answer the phone, so this is our main line. And if you want to book time with Len, you can go to the schedule page. Len's pictures there. You can click the schedule button, and it'll bring up his real-time calendar to book a free 60-minute retirement consultation. Again, no strings attached. That's your opportunity to talk to Len and ask questions about your plan. And then you can also email us as well. Len, any closing remarks before we wrap this up?
Nope, I don't think I have anything else. I think we've covered, looked at all my notes and looks like we've covered everything. Yeah.
Good. And then if you have questions, reach out, let us know. I know everybody's situation is specific and different. And there's a lot of things we probably didn't talk about. I will share with you that we have probably heard it. So if you have a question specific, could be in regards to refinancing a home, to living trust, to maybe a parent who's needing care. I mean, it's the depth of our work we do for our clients is deep. And so if you have a question, please feel free to ask us, and we're happy to give you some feedback on that call. So I want to thank everybody for attending and spending time with us, and we hope you all enjoy the rest of your week, and thank you for attending. Bye-bye.
Thank you.